Welcome to the incredible strategy of writing naked calls. But first off, I need to read this disclaimer to you. Unique experiences and past performance of anything discussed or demonstrated today is not guaranteed and may not indicate future results. Examples are non-representative of all trades. Certain trades may have substantially worse performance than indicated. All markets have inherent risk, and there is always the potential for loss. Today's lessons are for educational purposes only. I do not have a financial services license, nor am I licensed to give personal financial advice. So again, today's lessons are for educational purposes only. So now we've got the formalities out of the way, let's get into some great learning. My objective is to give you a better understanding of how to trade options. This will enable you to stack the odds in your favor to become a consistently profitable trader. When you learn how to trade options, you will never buy another stock again. And when you learn how to be an option seller, you will never buy another option again. So my main goal is for you to learn how to be an options seller. What are options? Well, there are calls and there are puts. And you would have learnt all about this in the Options Essentials video. If you haven't watched that yet, I suggest you go back and watch it now. So pause this, go back and watch it now, and then come back, because you need to know all about options before you learn the strategy that I'm going to be teaching you today. There are two sides to every trade. Every options trade, whether it's a call or a put, has to have both a buyer of that call or put and a seller, which is the writer of that call or put. As you can see on the screen there, the buyer pays a premium. They pay the premium to the seller. Then the seller assigns the rights to the buyer. So buying versus writing. There are two big reasons why we write options instead of buying them. As we've learned in the previous videos, the probability of market direction is 66%. And we've also learned that over 80% of options expire worthless. So when we add these two together, with those odds, doesn't it make sense to be an option seller instead of an option buyer? Buying options is directional trading. It is the most difficult form of trading, as you have to predict the direction of the stock. Calls, puts, and their outlooks. Selling a call. That's what we're learning here in this session today, is about writing naked calls, which is selling a call. That's short. We're bearish. You think the stock will be worth less later, so you want to lock in today's price to sell at a later profit. For example, let's say a stock is trading at $20 and you think it's going to go down. You could sell a $20 call for $1 to lock in the price to sell it later at a profit. Selling options is money coming in. If the stock goes down to say $15, you have the rights to sell it at $20, therefore making $4 per share. $5 minus the dollar. Writing calls is a bearish strategy. The writer has the obligation to sell the stock at the strike price on or before the expiration date. Limited profit potential if the stock goes down or stays flat, but unlimited losses if the stock goes up. Now the chances of this trade being profitable because of the direction is 66.66%. We learnt those chances in a previous video. Now writing calls. When you sell or write calls, you are selling someone the rights to buy your stock from you. If you own the stock, you would be writing what's known as a covered call. But if you do not own the stock, you would be writing a naked call. So you're naked, meaning that you don't already own the stock. Now option gamblers buy calls because they think the stock is going to go up in value. Now remember, over 80% of options expire worthless, so we want to sell calls to the gamblers who are trying to pick the direction of the stock. Now, novice option traders buy cheap out of the money options. Take their premium and play the odds, because we want to be the casino, the house. We want to sell the bet, and the bet is the call, so we can collect that premium. Writing calls, important entry guidelines. 1. Sell a call at a price that you don't think the stock will go up to. So we check our resistance levels for that. 2. The strike is to be above resistance. 3. High implied volatility, IV, so we can capitalize on decreasing IV over time. 4. The expiration date is to be between 30 and 60 days. So we're selling time, so we need time on our side, which is why we go out 30 to 60 days. 5, 75 cents or more in premium, because that will give us $75 or more per contract. 20 or less delta to give us an 80% POP, probability of profit. Delta, one of the option Greeks. It's the amount by which the option's price will change if the stock moves up $1. E.g., if a call option has a delta of 80 and the stock moves up $1, your option premium should increase by 80 cents. Now, delta is a great indicator of POP, the probability of profit. For example, if a call option has a delta of 80, then it has an approximate POP of 80% to expire in the money. Now, we don't want these to expire in the money. As an option writer, we always want it to expire out of the money. That is why we want a delta of 20 or less. So we're stacking more and more odds in our favour. So my delta rule for writing calls is a 20 delta or less, which means the stock has an approximate 20% chance or less of being in the money at expiration. We want our sold option to be out of the money at expiration, so we can use delta as a means of determining which option to sell or write. So here in this case, we're stacking the odds 80% in our favour. And the person who's buying the option from us, wow, the odds are stacked 80% against them. Again, we want to be the casino. More Greeks. There is also gamma, which is the amount by which delta will change if the stock moves up 1 point. Theta, it's the amount by which an option's price will change if 1 day passes. I like looking at theta because if the stock stays the same price, just flatlining, the option premium is still going down in value because of time decay, and theta will show us that. Vega, that's the amount by which an option's price will change if implied volatility increases by 1%. So as an option's volatility increases, so does the premium. Simplicity rules. We can make our trading as complicated or as simple as we want. Keep it simple and follow my simple rules. Now, it's not always possible to achieve the perfect trade setup. So you have to decide if bending the rules is within your risk tolerance. See, before I mentioned about the 20 delta. Well, if it's 21, 22, 23, is that close enough? I also mentioned before about wanting at least 75 cents a premium. Okay, is 72 cents enough? So we don't have to be so rigid with our rules. Cash is a position too. You do not need to be fully invested. Always keep some cash in reserve. We're going to need that for our margin as well, which I'll discuss shortly. Well, here we go. Why don't we discuss it right now? Margin. It's when you write a naked call, you earn the credit for selling the premium. That's money coming into your account. However, your broker will set aside some money to cover part of the risk. This is known as margin. Now, when you place a trade, you will see the amount of margin required. The margin is fluid. This is really important to know this. Margin is fluid. It's meaning that it changes dynamically as the stock prices goes up and down. So the closer you get to being in the money, the margin increases. And conversely, the further the stock goes out of the money, the more the margin decreases. Now, opening and closing naked call trades. When you go to open a trade, you sell to open. We're selling someone the rights to buy the stock from us. Right? We're selling a call, so sell to open. When we go to close the trade, well, we have to buy it back. So it's buy to close. So we want to sell at a high price, and then as time goes by, time decay kicks in and that option becomes worth less and less and less, and then we go and buy it back at a cheaper price, and we keep that difference there between our sell price and then our buy price later. Now, writing calls is not that scary. I might have scared you before by saying that the risk is unlimited, which it is really, because a stock can just keep going up and up and up and up and up. But let me show you how simple it is to write a naked call. Okay, we're continuing along with our Boeing trade. Okay, so this time we're going to have a look at writing a naked call. We can see up here we've got, what are we up here? 180, and above that is 185. So it had problems getting above 185 before. So it's still trending sideways, which is nice, but up a little bit on there. So let's have a look at writing the 185s. So we go trade, come down here to the 185. We can see we're already in a trade here. I'm actually in an iron condor already on Boeing. So if I go and click on here, and if we go to sell the 185 calls, it's going to bring in $325. Now our risk is undefined because how high can Boeing go? Now we can see here that our buying power effect, the broker is going to set aside $1,608 for our margin. Now remember, our margin is fluid, so as Boeing goes up and down, our margin requirement is going to go up and down as well. Our delta here is at minus 21. Well, we'd really like it to be minus 20. Well, that's pretty close to minus 20. So we've always got to have a little bit of fudge factor there sometimes. So let's have a look at what our rate of return would be. If we bring in $325 and divide that by 1608, okay, it's going to give us a 20% return. Not too bad, 20% in a week to 2 weeks from time. So what if we adjusted that? What if we took on a bit more risk and we said, okay, well, let's have a look here at the 180s. Okay, and that's what I did in the Iron Condor. I wrote the 180s and the 185s there. So let's look at the 180. The 180 is going to bring in $405. And our buying power effect, we can see that's increased. So in other words, our margin has increased now because we've bought on more risk. The likelihood of Boeing going to 180 is greater than the likelihood of Boeing going to 185. So let's have a look at that as a rate of return. We've got 405 divided by 1528. Okay, it's a 26% return. Okay, so we can see the difference in the return that we can receive there now by increasing our risk a bit there on that. So it all depends on your risk tolerance. I always prefer to play it safer because you can always go and trade again another day. So hopefully you enjoyed that, and that shows you how quick and simple it is. So to place this trade, all you have to do is click on Review and Send. So that's how quick and easy it is to place a naked call trade. Now that was pretty cool, wasn't it? Nothing to be scared about there at all, and so quick and easy to do. Early assignment. Now let's have a look at buying options versus selling options. Here in this case, what are we learning today? We're learning about writing naked calls, or in other words, selling calls. So we need to look down here, selling calls. When selling calls, you have the obligation to sell a security at a specified price. In other words, in this case, selling a stock at a specified price. That price, of course, being the strike price. The call buyer can call the stock from you at any time. This generally does not happen prior to expiration, as there is still time value left in the option. But it can happen. Now, why would a person go and exercise that right? Because there is time value still left in that option. See, when we write out of the money calls, out of the money calls is 100% time value. So whatever value is in that option is time value. So it doesn't make economic sense for somebody to call the stock from you prior to expiration. But if it does, you will be short the stock. And if you do not have enough money in your account to cover the stock position, your broker will give you the choice of adding more funds to your account, or they could liquidate the stock at market price. For example, if the stock is trading at $110 and you previously sold a $100 call, you are obligated to sell the stock to the buyer for $100. The net loss would be $10 per share or $1,000 per contract, less the credit or the premium received from originally selling the call. See why we don't want our calls to be in the money? We only want them to be out of the money. So we sell out of the money calls. We sell at a price that we don't think the stock will go up to. We don't want to be selling a $100 call and then next minute having it being $110 and then losing $1,000. You got it? Okay. We sell at a price we don't think the stock will go to. Now here are some important exit guidelines. When your entry order is filled, immediately place an order to close your trade at 50% of the maximum profit. For example, if you sold a call for $1 of premium, place an order to buy it back for 50 cents. Always exit your trade prior to expiration to eliminate any danger of it expiring in the money. If your trade expires in the money, you will have to deliver the stock. But it's not going to happen to you because you're going to follow the rules and you're not going to let it expire in the money. Now, what about some protection? You can protect your naked written call position by buying a call further out of the money to protect the upside risk of writing naked calls. Remember before I told you there is unlimited risk or undefined risk because we don't know how high up a stock can go. We can cap that risk by buying a call further out of the money. This is what is known as a call vertical spread or a bear call spread. Now, call vertical spreads are a fantastic strategy as they have both the maximum profit and the maximum risk defined. And I always suggest that new options traders cut their teeth on vertical spreads. You'll find another video in my video library teaching all about call vertical spreads, or the ones that we like doing the best, bear call spreads. Now, never let a naked call expire in the money. Never. I'm just going to say that one more time. Never let a naked call expire in the money. Now, when a call option expires in the money, well, I shouldn't even be telling you what happens because it's not going to happen to you because you're not going to let it happen. But anyway, just in case you have to know, here's what happens. A call option is considered in the money if the strike price is lower than the current stock price. The seller of a call option that expires in the money is obligated to sell 100 shares of the stock at the option strike price. See, as a seller or a writer, you are obligated. For example, if the stock is trading at $110 at expiration and you had previously sold a $100 call, you are obligated to sell the stock to the buyer for $100. Therefore, you would lose $10 per share. One option contract controls 100 shares of stock, so that's $1,000 per contract. Margin call. As mentioned earlier, margin is fluid, meaning that it changes dynamically as the stock prices goes up and down. So the closer you get to being in the money, the margin increases. And conversely to that, the further the stock goes out of the money, the more the margin decreases. So, never use up all of your funds in your trading account, or you will receive what is known as a margin call. If you receive a margin call, your broker will demand that you add extra funds to your account or close open trades to cover the costs. If you do not comply, generally within 48 hours, your broker has the rights to close any of your open trades to cover the costs. Now, if this happens too many times, your broker could close your account and ask you to take your business elsewhere. Guys, this is a business. Our trading is a business. Just do the right thing. Follow the rules. If something happens and you do get a margin call, top up your account or simply close out some of your other trades that are open, and then that will then reduce your margin. Too easy. So be responsible. Never use up all of the money in your account. The education process. Repetition. We must watch or listen to material 5 to 7 times before we fully comprehend it. Go over it again and again. I've covered a lot in this tonight. I've covered a lot of new material here, guys, that may be over your head. It may not be, but if it is over your head, so what? Just go back and watch it again. Watch it a couple of times, and then you'll get that aha moment, the moment the penny drops. Aha, I've got it now. Paper trade. Paper trade at least 10 profitable trades in a row before using real money when we learn new strategies. Practice makes perfect. Heard that before? Well, that's wrong. Perfect practice makes perfect. That's the 3 P's of trading. See, practice does not make perfect if you are practicing wrong. So we have to perfect our practice and make it perfect. Think big. As long as you have to think anyway, how about we think ginormous? Now, if you haven't joined my online trading room yet, it could really be your key to freedom. It can take you from working 60 to 80 hours a week to only 30 minutes a day. And no, you don't have to be like that picture on the left-hand side. You don't have to have 3 monitors there staring at them, analysing everything. That's my job. Yes, I have 3 monitors. That helps me to be able to find great trades for all the people that are in my online trading room. Because what I do in my online trading room is that you're virtually leaning over my shoulder, watching me place live trades. You could be like that family there on the right, having a great life, sitting on the beach, spending 30 minutes a day adjusting your trades. I have an offer for you now with my online trading room, where you'll get access to my advanced training videos and my trade alerts. $14 for 14 days in my trading room. Let me be your mentor. For today only, $14 for 14 days. You have no long-term commitments. That's purely a trial. You can cancel at any time, and I'll give you unlimited personal support. You'll get access to our exclusive Telegram group, so you can write to me directly and personally. And at the end of that 14 days, if you don't think you've received $14 of value, just send me a personal message and I'll refund your $14 and we'll part as friends. But $14 is a very small price to pay to get access to all of my advanced training and to also to be able to join in on our exclusive Telegram group. So hit the subscribe button below and I'll see you in the members area.